Good morning, everybody. Welcome to the Locking Your Success Trading Market Update for September 29th, 2014. Before we get going, we'd like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that we do use hypothetical computer simulated trades during the presentation that are believed to be as accurately represented as possible. However, it is possible that live results may vary. And also, please note that the risk of trading options can be substantial, so please be aware of all your risks prior to placing your trades. If you watch this on YouTube or some other venue, come on over, check out our programs, the M3, Bearish Butterfly, ROCK, M21, and group coaching. And join our mailing list and get your free reports, 7 secrets to becoming a successful trader, and sign up for this free webinar. Okay, before we get going, just a quick note here. That I have been extremely busy and I am behind on emails, so if you have an email into me, just be aware I'll be probably 3 to 5 days, unless it's something that's really urgent, in which case let me know, and we'll put it ahead of some other things, but general email questions are a bit behind, so just keep that in mind. As far as the markets go, we're just continue to be in this choppy, unpredictable market. And if you remember last week, I was kind of leaning towards things going up because there were some shorter-term support levels we were at, and in general, the NDX, the SPX, the Dow, all those charts were still kind of in bullish territory. That being the case, I was kind of leaning towards the market going up. However, that was kind of a flip of the coin. What we ended up having is we had some shorter-term support levels that were broken in the market, and we had the NDX that came down to, if we come back to the NDX, just came down to a primary support level, which is kind of normal. And that being the case, this chart as of Friday is still longer-term bullish. The Dow, we had a failed breakout. Usually a failed breakout results in a fairly substantial down move, making this chart shorter-term bearish. So we have conflicting information between the NASDAQ and the Dow. We did get a bounce back up over the initial breakout level, which is kind of unusual for that to do that and then fail again, so we have a double failure. And it just points out to more unpredictability in the markets, but in general, I would say this is pushing towards the bearish side. If we look at the SPX, we broke down over our support levels, which again leans a little bit towards the bearish side. And of course, the Russell, we just kind of broke down to our next support level at this 1010 area. So essentially, it looks like the markets for now, I'm not really too concerned. I know the open looks ugly this morning, but it looks like we're pushing more into more and more into more of a sideways trend in all the markets. And as this happens, usually things get a little bit choppy. So as far as the Russell goes, with it at this level, I'd be a little surprised if we don't try and at least test the 1090 area, probably more down closer to 1080 before we go higher. I'm not convinced we're going to break the range yet, although the fact that we're underneath our trend line here, if you look at this trend line, this has been in place since, look at our monthly chart, pretty much been in place since the 2009 bottom. And to me, this is significant. If we close the month under here, it looks like there's a good chance that we're going to do that. So as far as turning around, I don't know if it's significant as far as turning around, but as far as coming into a longer-term sideways market, and maybe even a little bit bearish in the small caps, it looks like that's coming that way. So that's just some of my comments as far as that goes. So from here, it looks like we kind of have more of the same choppy sideways movements. The Russell coming towards its more primary support levels. The SPX, Dow, NASDAQ probably look like if this breakdown this morning holds, we're breaking some support levels. I'm thinking that we do have some more support in here at the 1950 range in the SPX, so we may come down to that area. And where we go from there, if we get a further breakdown, we'll have to watch the Russell, because the Russell doesn't have any support underneath here, really. If we come to a 5-year on the Russell, there's not a whole lot. I mean, we got a little bit. If we start breaking down from this area, we got a little bit here at. I mean, you can maybe come all the way down to close to 1050 before it gets too ugly, and then we drop down another 50 points to 1,000. Then we have essentially 50 point support levels, but we have nothing major to 850. So a real breakdown in the market get kind of ugly. I don't think that's going to happen, but just so that you're aware of where our next really hard support point is, it's at 850, which is quite a ways down because of 2013 was so aggressive. All right, so that's what I'm thinking in the markets. If we come over and take a look at what's going on with the trades, we are getting closer to expiration. We have our October M3 trade that we had on as of Monday morning. Looking to get out of this at $5,000 profit target. We had a pretty good down move on Monday. And let me see, by the end of the day, I was pushing my maximum delta limits. So let me see what time of day I actually move this back. On the 22nd, today is, let me get the back trader screen over there so you guys know what day this is. On the 22nd, looking at our T-log. So let's just go to the end of the day here. I end up doing a rollback, and I rolled these 1130s back to 1110, and we separated the shorts. We put the shorts at 1110. Right, the butterflies were originally at 1130. We rolled them back to 1100, 30 points. We put the shorts 5 at 1110, 5 at 1130 to maintain some positive delta here. And we're right up near our profit target, but not to the point where we could actually get out at that prices. So here is what the position looked like as of Monday. Tuesday, the market continued down. And what we did, we rolled our 5 shorts to 1130 down to 1110. And we took 5 of these 1150s down to 1140 just to correct the upside risk here. And we ended up losing a little bit of money that day, but we're still maintaining our positive delta. And we're in a position that looks like this. So we're gradually rolling our tent back. We're taking off our upside risk at the same time and bounce. And from there, I don't think there was anything else that happened. Nope, we just went to Friday. And we were able to pull the trade off. Come to Friday at, say, 1300, just to get an idea where we were. Up around $5,900. We are looking really nice. We're kind of right in the middle of the tent here, but it was time to go. So we went and pulled this off. Pulled the trade for a profit of, let's go to the end of the day here. Actually, it was going to. The final numbers came in at 59.72, or 12% of planned capital. So a really good month for the M3. Yeah, M3 T-log, complete T-log, sure. Let's see if we can open this up. And that is that's what the complete M3 T-log looks like from entry to exit. Really fairly simple trade for October. We didn't get a whole lot of market movement, a little bit of chalkiness here towards the end, but pretty straightforward. Okay, great. And let's see. So the other let's see. I didn't change anything, but we'll save them. All right. So the next trade we got going on here would be October Bearish Butterfly. Take a look at the October Bearish Butterfly. Really had nothing going on there either. We just had, I don't believe there are any adjustments during the week. So here we are sitting, oh yeah, there was an adjustment this week, I apologize. So October Bearish Butterfly, we're sitting up here at the 1120 short strikes. And on Monday we had down move, I think it was Monday. No, it was Monday. I guess we survived Monday okay. We didn't hit our adjustment point, but on Tuesday we hit our adjustment point. So let's go to Tuesday, a little bit earlier in the day. So we're sitting here. We're back all the way down near 1120, which is 40 points under our short strikes. We are up about $3,600. Here's what the position looks like here. We're clearly at our adjustment point, so we went ahead and rolled this back to at the money, which is as per guidelines on Bearish Butterfly, and ended up the day looking like this. So the pricing came back a little bit by the end of the day, and we're sitting here right in the middle. And from there were no further adjustments. That was the only adjustment for the week. And as of as of Friday, we hit our expiration guidelines, 21 days to expiration guidelines. And this is what the position looked like on Friday. I pulled it off before then. So here we are Friday at about 1:30. We're up about $6,600. We have our reduced profit guidelines, 21 days to expiration, and I went ahead and closed the trade out a little bit later in the day. So you know what? I don't think I shortened the leg on the bearish butterfly. You know what I did? And this was an accident within the trade. So apparently when I rolled it back, I bought the 1060 trades instead of the 1170s, which I actually didn't even notice. So, yeah, so that was an error on my part. So coming here, we did the rollback to at the money. I accidentally widened the leg, which was a complete accident, by the way. That was not done on purpose. So if we want, we can come and look at what that would look like had we rolled it back to the proper point, the 23rd. All right, so here we are. We did the rollback. If I were to take this, and let's just do this. Let's put this the way it was supposed to be, so you see how that works out. For a trade, and we go to Friday at, I think, 13:30. We'd be pushing about 67.70. So it didn't make a whole lot of difference. I think as it stood, let's take that back out again so we don't goof up the T-log. 67.70 ended up with, it looks like 67.60. So a very, very little difference there. So didn't really make a whole lot of difference. But yeah, that was an error. Hold on a second. Oh, never mind. Now I goofed up my exit. Let me put these two out. Okay, yeah, so it made a difference of about $100. Now I'll have to fix that later. But anyway, this came out to a profit of, let's see, 67.90, or a gain of 13.6% of my capital. So that was the two closed trades for October. And let's just take a look at how we're doing for October, since we've closed those two. Bearish Butterfly as of October, 13.6%. Another win here for a total of 9 wins, 1 loss for the year, 123% return on the Bearish Butterfly. And we have a, as far as the M3 goes, 11.9%, 10 wins, 0 losses for the year, 78.7% return on capital. Okay, I just have a question here. It just says, I'm a first-time attendee. Are the trades that you show presentations, paper trades, or are these actual trades? We are restricted to doing hypothetical trades within, because we are on SMB, because we post these on blogs on other sites that restrict us from doing live results on them. So these are real-time computer simulated trades, and I do have similar trades most of the time in each of these that are live. So, but as far as results here, we're showing simulated. Okay, so moving on, those are the real results there. The other October trades, we have an October rock trade going on. So let's kind of take it back there. Remember, the October rock trade was actually entered as a bearish butterfly. This is what we were looking at as of Monday morning. We were pushing too much positive delta. So we went ahead by guidelines, and we essentially did the same thing we did with the M3 trade. We rolled this back to 1100. I am positioned slightly differently here than the actual M3 trade. As you know, we started later, which means our profit loss, we just started this a week, 5 days ago. So the profit and loss is going to be fairly flat. So here's what we look like as of the end of Monday. We roll back to 1100. If you remember, on the M3 trade, we did this on Tuesday. because we were a little bit more aggressively positive delta on the ROCK trade, we ended up doing this on Monday. And then on Tuesday, I had another small adjustment where we rolled back 5 of these 1120s to 1110 just to deal with, again, another positive delta issue. That put us in a position that looks like this. And from there, let's see, 22nd, 23rd, nothing. So from there, I'll show you what we look like as of Friday afternoon. And here is here's this position. So everything's fine here. It looks like I said, if the market's down today, we end up adjusting this back again. But as of right now, we're up about 1472, and everything is looking fine. And the last trade that we have on for October is going to be the October V trade, which is going to look like this. If we take a look at what's going on here, this trade's up about $800. Here is where we're sitting in the position. If the market bounces from here, we're going to be starting to pull this V out to protect the downside. But as of right now, I'm perfectly happy with it in there, especially with the market continuing to drop. So this is what our V trade looks like for October. There were no adjustments. So okay, moving forward. Yeah, I see I have a couple of questions here. I'll get to those just after we do the adjustments, unless it's something that's relevant to a particular trade. So coming from here, we'll go into the November trades. So far for August, what we have for October, we have opened the ROCK trade still. We have opened the V Condor. We've closed 2 profitably. For November, we have the November V Condor. We'll start there, which has had no adjustments either. We're sitting here, we're down about $1,000. Here's what the position looks like right here. If we shoot over to the November Bearish Butterfly, that was put on Friday. Actually, let's do, yeah, okay, so we entered 2 trades. We entered the November Bearish Butterfly on Friday, which was entered at 1090 short strikes. Position looks like this. Obviously, if the market goes down, we have that's a good thing for us for today. And of course, if we bounce, we just follow our guidelines. But that's where we entered the market, and we also entered the November M3 trade, which is right here. So we entered the same strikes at 1090, added a call up here at 1050, and this is what our November M3 trade looks like. So that's our starting position for the month. So that is all the trades that we have going on. And it's going to jump over to a couple of questions that I have. Let's see. Can that Performance Excel be downloaded? If you email me, I can email it to you. I don't have it up in the site where it can actually download it anywhere, so we can do that. What do I think of weekly options? I mean, weekly options are fine, and I've always said it. I coach day traders, I coach swing traders, I coach complex options traders and investment traders and people who trade weekly options. I personally like to do the monthly options better. Long-term results tend to be better. The thing with doing weekly option spreads like this is you'll have periods of time where you have very good performance for long periods of time, and you'll have long periods of time where you have very bad performance. So, and plus your risk is much higher into weeklies, so if you're doing weeklies, you should be trading a much smaller portion of your account in those weeklies, because you're more likely to take a, we always have our maximum loss numbers on our trades, but we also have the number of the total loss, which is the total investment you have in. If you stay away from expiration, your chances of hitting that total loss are virtually zero. If you run stuff into, if you're doing a lot of weeklies, your chances of hitting that number are exponentially higher. So if you're always in the weekly cycle. So for that reason, you'd want to be trading smaller. That said, there's nothing wrong with it, which is if you're the type of person who requires a lot of quick feedback, then certainly weeklies can provide that for you. So you can go ahead and do that. If you're the type of person who doesn't want to sit and watch the market all day and do that, then the longer term tend to be better for most people. The other thing with weeklies is they do take more discipline, and they're harder to make money with. So over time. Do I do a live V Condor every month? No, I don't. The V condor returns are not high enough for me. Most of my money is in the M21 trade, so if you're following my systems, they would, I take market direction and my opinions into consideration, and I form a trade using the bearish butterfly, the M3, the ROCK trade, and some various other techniques to take maximum advantage of what's going on in the market. So I can really boost the returns. So especially for those of you who are new here too, I mean, these trading systems are the M3, the Bearish Butterfly, and ROCK trading systems are designed. They're standalone systems that work very, very well. And I have programs out, and we follow the guidelines on the website within the programs, regardless of what the market's doing. And we just see how they come out, and we give you the performance of that. And the purpose of the systems for people, if you want to go further than that, I mean, a lot of people just trade an M3, they're perfectly happy with the results, and they don't want to do the market direction thing. It's a very, very powerful, effective trade that works really, really well. And I do trade a large amount of money in an M3 style of trading where I don't take market conditions into consideration. However, with a large part of money I have, I do what we call an M21 trade, where all these systems lead to. And we start taking technical analysis and creating a customized plan for the month. So that's kind of how the systems fit together. As far as the V condor, I don't trade that every month just because there's not enough really profit in it for me. But it's a fantastic trade for people at a certain skill level and in market conditions that are relatively calm. It's a really, really nice trade to do that you can do month after month. It's just that there's nothing wrong with it. It's awesome. Like I said, you're just not going to pull most years. I mean, 2013 was an exception. 2013 was one of those years where we've never seen a year like that. So that trade did exceptionally well in that type of a year because the environment was very conducive to it. But you get into a choppy market like now, you notice the returns in the V condor are down this year. What's your guess on how much real-time results differ from the back trading? Generally, I find that I usually do better in real-time than back trading. So, and there's another question here, right? Because you lose 1% or more on fills. Here's the thing about fills. You should be able to, if you're trading effectively, you should be able to go through the trade, and if you were to come in here and just fill the thing, in other words, you went in live, you put your positions on, and then you came in and you just filled it in back trader at mid prices with no slippage, you should be able to do, on average, better than or about the same as what option view shows you. And I've had this conversation with somebody else. That's different than saying you're going to get mid price on what the listed price of the option is. Because mid price doesn't really matter. It doesn't. You'll find the more you trade these, that mid price doesn't really necessarily reflect the purchase price of the option spread that you're buying. You're going to find mid prices fluctuate a lot, and if you go in and you price the synthetics of your position, there are large differences, and they fluctuate up and down a lot from day to day, or from minute to minute, which means that when you take a look at it mid-price and you instantaneously look at a mid-price, that price isn't necessarily reflective of what that spread is going to go for. So we have a process in the M21 program where you come in, you analyze the price of the spread over time, you analyze the price of synthetics, you determine what a fair price is for the spread, and that's what you try and fill it at, which may be significantly above the mid-price, it might be significantly below the mid-price, or it might be right at the mid-price. At any given time, but you can't arbitrarily put a slippage number in. And in general, once you're effectively filling and trading these positions, you should be able to do better than what option view shows you. All right. Okay, I have a futures account only. Can I trade the M3 and Bearish Butterfly in the ES? I don't trade them with futures options. I trade them with regular index options. It doesn't mean that it can't be done. I've had some people who have traded it. I suggest you just get a regular account and use the regular options. So usually they're a little more thinly traded, I honestly don't know how liquid they are and how easy they are to move around. You could try it with a small position, see how you do, come back and let me know. There's really no need to do it differently though. Okay, so why don't I trade iron butterflies on the bearish butterfly to get tighter spreads? Here's the thing, you guys, with butterflies or deep in the money calls or out of the money calls or puts or whatever, yes, an out of the money option always has quote unquote tighter spread. Also, they'll always fill at the same price. So it doesn't really matter what the spread is. The price you fill is going to be the same. And I mean, there may be an anomaly where that may be different, but for the most part, I've come in here. I've had, we do a lot of experiments with fills and stuff like this, where I've had an iron butterfly on, I've had put butterfly order, an iron butterfly order in, a put butterfly order in, a call butterfly order in, all at drastically different prices. Like you might have a call butterfly saying, you know, that with a, say you got a 50-point iron butterfly with a $40 credit, that's implying that you can buy a call butterfly for $10 or a put butterfly for $10. So you might have that $40 credit in an iron butterfly, and you might have the puts priced at $9.50 and the calls priced at $10.50, and you can put the orders in all at the same price. And you know, if you put the order for $10, for example, and it doesn't fill, you know, you're 50 cents above mid on your put butterfly, and that's not filling. You're 50 cents under mid on your call butterfly, that's not filling, and you're you're right on your iron butterfly, and maybe that's not filling. But then when you move the prices on them, just to the point where all three of them fill virtually instantly at the same time. So there's really no actual difference. So you're kind of focusing on the wrong thing there. That said, I would try to keep most of my options out of the money on entry, which when I do a bearish butterfly, for example, if I do this position, actually if I move to a bearish butterfly, for example, if I do a November bearish butterfly here, and I do a put butterfly, I actually have three options, two options strikes out of the money, and one option strike in the money. When if I do an iron butterfly, I basically have the same thing. I have my calls up here out of the money, I have my puts up here out of the money, and my puts here out of the money, but I have my calls here in the money. So I'm still buying, and they're actually more in the money than these are as puts. So I'm actually still buying in the money options that have the wider spreads on them. So, I mean, it really doesn't matter. I mean, ideally, if you buy a bearish butterfly, usually what's going to happen is the market's going to go up. This is eventually going to be out of the money. Your next set of butterflies here at 10.10, half of that butterfly is going to be out of the money. And then if it continues to go higher, these just continue to go out of the money. They actually are out of the money. So when you get out of them, theoretically, if you're subscribed to the thing that, hey, I want to deal with out of the money options, they're easy to get out of than maybe a call butterfly. The reality is they're not any different, but I'm just kind of taking that theory to a certain direction. But essentially, it doesn't matter. If you prefer iron butterflies and you want to do iron butterflies, that's fine. Not an issue there. All right, so let's see. T-log for November 3. Yeah, for the entry. Yeah, let's go. The T-log here. This is what we look like for November M3. So it's just a entry with 1090 puts and a 1050 call. And here's just a note from Ryan. And thank you. He says 90% of my fills are better live than option view due to knowing actual pricing of synthetics. Thank you, Ryan. Yep, that's great. So there's someone else who's saying the same thing. If I'm trying to start a new trade in the November M3 when the volatility is high and the delta of the 10 flies is around 60, what do I do if I don't want to purchase a single call that's near the money? Right. So within the system, we increase the butterfly size. So instead of going in with 10 butterflies and one call, you might go in with 15 butterflies and call. And generally, when you do that, you may run into a capital problem later in the trade. If you do that, you drop back down to 10 butterflies. So as the, of course, if the market stays down, you're not going to have a capital issue. But if the market takes off to the upside and you have too many butterflies on, then what can happen is you get overcapitalized, in which case you just start dropping out of the butterflies as a delta correction method, and you'll get back to your normal size and trade it as normal. And do I generally monitor my open positions near the end of the day and make adjustments at that time, or do you watch them during the day? The systems are designed to not take intraday movements into consideration. So in general, I'm just going to watch them at the end of the day. That said, like on an M3 trade, for an example, especially close to expiration, if I have a situation where I'm taking on just too much risk to the downside, I will have an intraday adjustment point, but it's not going to be the same as my end-of-day adjustment point. So, for example, if I have a position that has 100 delta, maximum delta end of day, I might let that go to 150, 200 during the day, and then come back. Then wait till the end of the day and adjust it back to normal. And the reason for that is you have some pretty wide intraday swings that really don't mean anything, and you don't want to really be reacting on those unless they present a real danger to you. And most of the time they don't. So for the most part, so I will have an end of day adjustment. I'll have an intraday trigger, but it's going to be different. All right. So when I say price of synthetics, what do I mean? How do I do that? That takes a little bit longer than what we have here, but essentially I can, if I was going to do a butterfly, if I want to price a butterfly, I want to look at my my put butterfly, my call butterfly are the same strikes, my iron butterfly are the same strikes, and my inverse iron butterfly are the same strikes, and I want to make sure that the pricing matches. Right now, you won't get. If a put butterfly and a call are $10, and you price an iron's not going to be $10; it'll be $40. If it's assuming it's a 50-point wing balance butterfly, but you might have to do some math in there to do that. And an inverse iron is going to be priced even differently. So you go in there and you just do the math and see where everything is put together. So you would buy. So you look at all those options and kind of get an idea of what everything goes together. Do you have to use Option View or Thinkorswim to see the analytics? Option View analytics are what everything was designed on, and they're much more consistent and they're much more accurate as to what your T+0 line is going to do with price movements. So I strongly recommend Option View if you're doing any kind of complex options analytics. And if you're doing a simple bull vertical spread, it doesn't matter really what you use. If you buying calls and puts, it doesn't matter. When you start getting options in all over the place, it does matter, because the Thinkorswim system goes kablooey when you put a bunch of options in, and it's just all over the place, and it doesn't project an accurate T+0 line. Option View is really the only software that does that. And there's specific settings I use for Option View as well. So if you do buy programs, or if you're following along and you want specific Option View settings, again, email me and I'll get them out. And so you have the right settings. Because the thing with Option View is you can actually make your T+0 line project any way you want. And I have it so it projects a specific way that does well with these complex spreads. Okay. Do I actually make my own adjustments at 3:30? It depends on the trade that I'm doing. Yeah, right. If you find it doesn't leave you enough time to work the orders at 3:30, which I would agree with you, then yeah, essentially here's the concept: is we're not taking intraday moves into consideration. We're kind of checking these things once a day, whether it's at 3 o'clock. I mean, I have people who trade these and they're sleeping at 4 o'clock in the afternoon. So they're doing their. You want to stay away from the last half hour of the market. Again, for the last half hour because of time constrictions. I mean, you can be trading during the last half hour, but you don't want to start to initiate something really complex and get yourself in a position where you're forced to do something you don't want to do at the end of the day. And the beginning of the day, especially from 9:30 to 10, I definitely strongly recommend staying out of that unless you really know what you're doing. There's a lot of day traders pushing stuff around. Pricing can be all over the place. And unless you know what you're buying and you know what it should be priced at, you probably shouldn't be there trying to trade it. But anywhere between 10 and 3 or 10 and 3:30, to just pick a point in the day to make your adjustments. Like I said, the overseas people who are sleeping at the end of the day typically make their adjustments at 10 in the morning. And I mean, the trade systems work fine. You might be in a bit of a different position, but it works fine. All right, so what's an inverse iron butterfly? An inverse iron butterfly would be if you bought the puts, if you bought the in the money puts for the top side. In other words, if this side of the butterfly was in puts and this side of the butterfly was in calls. So it would be backwards because most people do an iron butterfly. They have this side in puts, they'll have this side in calls. If you did an inverse, you'd have this side in puts and this side in calls. All right. So, yeah, OptionNet Explorer is basically does the same thing as Thinkorswim does. They don't use the calculations they use for the T+0 line are very simplistic, and if you have the when you get these large put call skews and you're dealing with stuff that's in the money, out of the money, calls and butterflies, they tend to have very unpredictable T+0 lines. It's not that it can't be done, but in general you'll be trading a lot more positive delta. Your T+0 line is not going to be right, and you're kind of guessing a lot. I kind of look at it this way: if you were experienced and you lost option view and you couldn't trade anymore with option view, I could go on a system like one and make the adaptations mentally so that I could get it to work okay using the one or even the Thinkorswim software. Learning a system is a little different. If you're learning the system and you're starting to learn how things react, throwing in that unpredictable T+0 line in the position not reacting the way that the software is showing you makes it very, very hard to learn, and you end up getting a lot of losses. You end up getting frustrated and jumping out of your system and moving around because you're not seeing the position is not acting like the way it's supposed to. So that makes it very, very challenging to do that. So it's not that the software is useless or anything like that. It's just that it makes it tremendously challenging to learn the system, and it's certainly, and you're guessing a lot more. So could I make OptionNet work? Yes, I could make it work. You're going to find it as a student very challenging to learn because you'll be losing trades and you won't know why necessarily. When you look at an option view system like option view, you can clearly see why. So that's why I'd recommend an option view. TOS doesn't have a good. Their back testing tool still needs some work for sure. Plus, their analytics are kind of goofy anyway. You get complex option spreads in TOS. The analytics, you can't trust them. Okay, so if I'm starting a new M3 trade today, would I wait till the end of the day or try to get in at favorable point? If you know the pricing you should be at, you can get in at any time of the day, and you just wait for your best fill, right? And I can't go over everything here because we're actually running late. I actually have to keep going, but if you know your pricing, you can get in at any time of day. If I know my pricing, I actually like to get in at the open because I can get some really, really spectacular fills on the open. And again, that's not fills as related to mid-price. That's fills as related to what I know that option spread should be selling for. So if I know this option spread, if I've looked at it over time, I know what a good value is for this spread. I want to go in and open, see if they'll fill it. A lot of times, often you will get a fill at a really good price, which may be more or less than mid-price, right? I'm not basing my value of my fill off my mid-price. I'm basing my value of the fill off of what I know the butterfly is worth, and if that's the case. So, if you don't know what it's worth, you're better off to monitor it during the day, see if you can get an accurate pricing on it, and just get it to fill. It's probably a good day to actually fill them if the market is still down. I don't know. I would imagine that it is. Yeah, we're down. Yeah, okay. Yeah, we're reversing now. But yeah, that being the case, see if you can get a good value for it and move on. Okay, so last question. Okay, seems pretty similar. There are a couple things I like better. Oh, okay. I think they're talking about. Oh yeah, he's just talking about one. Yeah, like I said, one is not. One in option view, there's a huge difference in the analytics. I've been through this with hundreds and hundreds of people, and people don't listen to me. They'll either use one and eventually give up because they're not getting the proper analytics, or they'll finally sit with me and I will show them the differences, and they'll say, "Oh my goodness, I can't believe I wasted all that money losing trades because I'm just stuck on using this software." So again. Option view with the proper settings is going to give you much faster learning. It more than pays for itself. If option view was $8,000 a year instead of $2,000 a year, whatever it is, it's still worth the money if you're trading any size, any decent size, because the losses that you take because you don't know where things are and you're guessing, it's well worth it. But that will be my last word on that. And you guys are your own people. You can do what you would like to do. All right. So yeah, cost-wise, option view is is it the same as one? Yeah, I don't know what the cost difference is with one because I don't look at it. All right. So that is that's it. So looks like we got all our questions. Thanks everybody for staying with me, and good luck in the markets this week. We'll talk to you next week.